Hi everyone. In this video we're going to be looking at the chapter 2 slides here, and I'll be providing a lecture on the topic of linking the concepts of personal accounting that we discussed in chapter 1 to business accounting as we kind of pivot towards more of the business focus that we'll have for the rest of the semester. Okay, so let's start with just talking about business accounts. And like it notes here, so far we've just learned about the personal context with personal accounting. And what they're noting here is that personal accounting that we've learned so far is very similar to the business accounting. That's missing a M there, but often there's some more complexity with business accounting. And so in this chapter, we're going to kind of review the similarities and differences, and it does list out a bunch of information here that we will cover as we go through the slides. And yeah, let's just kind of move on and we'll go through everything here. Okay, so one of the concepts that we need to discuss as far as a difference is really mostly just a terminology difference. When we're talking about business accounts, we're going to use the concept and the word equity in place of net worth. And remember that when we talked about net worth from a personal financial accounting perspective, that was basically the idea. What is it? Net worth is the difference between your assets and your liabilities, right? So if you liquidated all of your assets, paid off, sold them all, in other words, and then paid off all your liabilities, your debts, well, if there's anything left over, that would be called net worth. And similarly, in a business context, businesses have assets and liabilities. And so we really just have a different word, but it is basically calculated the same way. So nothing too significant there, but just note that net worth has a different word we use, and that's equity. You'll also see the term capital. And when we use capital, really we're talking about the specific ownership account, because a business could have more than one owner, whereas with net worth, you just are talking about the one individual. So capital is kind of the sub-account of the overarching category of equity, or owner's equity, you'll see as well. But pretty much equity, owner's equity, capital, you can all just generally think of those as the same thing, and they are equivalent to net worth from a personal accounting perspective. Here's a couple things that we didn't have in personal accounting: the idea of an owner's contributions or withdrawals from a business. And owner's contributions in this business context are essentially going to be cash, or it could be other assets invested into a business by the owner, and that will increase the owner's equity. So in other words, and maybe it's something I just want to highlight here, is that we think of these concepts of the owners and the business as two separate entities. And so if the owner is putting money into the business, it's essentially coming into the business's assets out of the owner's assets. And it doesn't have to just be cash that an owner could invest into a business. It could also be a vehicle or any asset, really. It just becomes the property of the business and is no longer the property owned by the owner or the individual, right? We'll practice with these with some examples as well in a bit. And then there's the concept of owner's withdrawals, which is basically the exact opposite, where an owner might take money out of the business for personal use. And so again, we have this concept where we look at the owner and the business as two different entities. And so for an owner to actually get money out of the business and be able to kind of make money or spend the money that the business has generated, the owner will take a withdrawal and essentially remove cash or other assets from the business, and that will go into the owner's personal accounting, but it will be reduced from the business's equity. And again, we'll have some examples for both of these. Here's a little example of the calculation of equity here for owner's equity. So just like with any of the accounts we looked at on the balance sheet. In Chapter 1, we have a beginning balance, and then if there's any contributions or investments into the business, we add those to equity. Then if we have net income, which is similar to surplus, or we had deficit, so we have net income and loss. Those are the terminology differences there in a business context. So if revenues exceed expenses, equity goes up. If expenses are greater than revenues, then we have a loss and equity will go down. So remember, those are key concepts. That was pretty much similar to Chapter 1's perspective on surplus or deficit, revenues and expenses. But then we also have this concept of the withdrawals. So money could be put, or other assets put into the business, and then money or other assets can also be taken out of the business by the owner for personal use. So this is just basically listing out the same idea of equity. Owner's equity is just, again, taking the assets minus the liabilities. And this is a good slide. I like this slide to highlight, again, here's the accounting equation, assets equal, and before in Chapter 1 we said liabilities plus net worth, but now we're saying assets equal liabilities plus owner's equity. And then these are kind of the subsidiary components of owner's equity, again, being withdrawals, owner's capital, which essentially also represents investments and contributions. And then you've got revenues and expenses down here. And it shows you on the T accounts what side, left or right, is an increase or a decrease. One terminology difference here I'll highlight as we go over this slide is that we had this concept of unpaid accounts previously in personal accounting, but with businesses, when they receive a bill that needs to be paid or some other service, for things other than mortgages or long-term notes payable, et cetera, bank loans, for ongoing expenses that need to be paid and for which the expenses have been incurred because the services were provided, for example, but the payment hasn't yet been made, we have a liability account that the business will record that amount into, and that's called accounts payable. So we're not really going to see this unpaid accounts terminology anymore, but instead we'll see this liability of accounts payable for businesses. And then again, this one was just talking about owner's equity being comparable to net worth. Okay, let's talk about different types of businesses here and some of the financial statements, etc. And so there's kind of three key types of businesses that the text identifies here. And those are service businesses, merchandising businesses, and manufacturing businesses. And they kind of go in terms of in varying degrees of complexity. So you have a service business, which is the most simple version, and that will just be, you can tell from the name, a business that provides some sort of service. So they're not selling any products, they're just providing services. This could be maybe like if you were to open your own accounting or bookkeeping business and you're providing a bookkeeping service. You're not selling any products to your customers, but you're selling them your work, basically, right? So that would be a service business. Merchandising business is a business that will buy products and then sell them. And so that would be like a gas station, or any store that's a retailer, any retail store that's selling products and selling products that they did not specifically manufacture themselves. And then on the far side of the most complexity here is a manufacturing business. This might be something like, typical examples locally in Chico would be like Sierra Nevada brewery, certain bakeries and things like that. There's lots of businesses that are smaller as well that manufacture products that they sell. So it's really the idea of selling a product, but instead of like a merchandiser where you buy something and then just resell it, you're producing the product. And you might sell it from the manufacturer to the merchandiser, which often happens, but the manufacturer also could sell it directly as well. And there can be overlap in these different types of businesses. Maybe a business sells products, is a retailer, but also provides services. Maybe they're a manufacturer and they provide some services. So it doesn't mean that you have to exclusively fall into one category or the other, but that's a general breakdown of the different types of businesses from an accounting perspective. And for purposes of this class, we just keep them separated out for simplicity. This just kind of goes through the financial statements of the different types of businesses. So we say service revenue for a service business. Here for a merchandiser, we're going to use the word sales revenue for products that are sold. And then we've got this concept of the cost of goods sold when we talk about a merchandiser, because here with a service business, there's just service revenue and then maybe some cost of sales. So whatever it costs to provide those services. With the merchandiser, they're going to sell products and then they have to recognize the cost of those products as a cost, part of the cost of doing business. But in other regards, very similar. And then a manufacturing business is going to have this additional category of inventory that they're producing. Well, I guess I should say a merchandiser has merchandise inventory, just stuff that they've bought, and it's an asset that they own that they will sell. But then when we get into manufacturing businesses, they have individual categories of types of inventory. They'll have raw materials in order to build, they use to build manufacture their products. They have work in progress, which is products that they are currently manufacturing that are not fully finished but are in progress. And then they have finished goods that are ready to sell. So what type of business will have raw materials inventory? That's going to be a manufacturing business, right? Here it talks about the listing of liabilities in the correct order. And as far as the listing of assets and liabilities, from an asset perspective, it's going to go from what's the most liquid to least liquid. In other words, what's the easiest to convert to cash? So cash is always the most liquid. That is like what defines liquidity. And then you'll see things like accounts receivable will be next. I'll show you, actually, let me back up here. So here you see cash listed first. Accounts receivable is more quicker to turn it into cash. Inventory maybe is a little bit less quick, but just behind accounts receivable. And then down at the bottom, you have things like buildings, the equipment, and all this other stuff that the business uses to produce the products or services, but are unlikely to be sold, or at least they are less liquid because it will take a lot of work to pay those. And then on the liability side, the way that we list these out on the balance sheet is we start with accounts payable. It's basically whatever is going to be paid sooner. And so accounts payable is typically the ongoing expenses of a business that need to be paid, that the business has incurred but just hasn't paid yet. Unearned revenue is this concept of prepayments from customers that until earned are a liability, but typically those will be converted to a payment sooner, paid off. Notes payable is more of those loans that are usually more long-term, maybe 5, 10 years, 15 years, whatever. And those are going to be farther down on the listing of liabilities because they will be paid in full at a longer time horizon. Okay, so I want to ask about what's the correct order. It would be accounts payable. Let's see, maybe notes. I think here accounts payable, notes payable, and then mortgage payable. Usually a mortgage is going to be a longer term 30-year loan or something like that. If the income statement of a company does not have cost of goods sold, what type of company is it? Well, it's definitely not a manufacturer, right? Because that's what they do. They produce products. It's not a merchandiser because they sell those products. So it's going to be a service business. Okay, let's talk about recording revenues. Okay, so the important thing to keep in mind here when we're talking about revenue recording is that we want to make sure that we understand the concept of this accrual-based accounting, where revenues are recorded when they are earned, regardless of when the cash payment is received from the customer. As it notes here, it's a timing issue to when cash is received. We don't know when it's going to be received. It could be received 2 days after the services are performed, or it could be received 2 years after the services are performed. Hopefully sooner, but certain instances arise sometimes where it takes longer to receive a payment. Maybe your invoice, your request for payment to the customer gets lost in the mail, something like that, and it takes a month or 2 months in order to receive a payment. And so we don't want to let those kind of timing issues modify the fact that we are going to be recording the revenue earned. And so we record the revenue earned when it is earned, regardless of when the cash payment is received. And here it talks about, so if we receive cash before the services are performed, when the services are performed, and after, those all have kind of different impacts that we'll talk about here. Okay, because sometimes you might even be, I guess I didn't highlight that, but you could be paid after the services like I talked about, but sometimes you could be paid before as well. You can think of an instance where you might have to make a prepayment for something, or a deposit, for some sort of service to be performed. And so if you are the business receiving the cash and you receive it before you provide the services, but you say you require the customer to prepay for those services, say you're a mechanic or something, and the customer has to pay you $1,000 now, and you're going to perform the repairs in a month or something, or whatever it might be. Sometimes that happens where a customer has to pay before you actually provide the services. So when the business receives the money, they need to record the cash, of course, right? It went into the business's bank account, and it possesses that money from the customer, but it has not yet actually earned the revenue, right? So back to that idea of recording only when the revenue is earned. So while we have the cash, we have not yet earned it, and so we record a liability for that cash up until the point at which we do provide those services. And so we have this concept called unearned revenue. And until the revenue becomes earned by us doing whatever it is that they're paying us to do, we're going to have to record that as a liability. And that might sound a little bit funny. It's not like a debt necessarily, but think of the concept that if you, as the business provider, maybe if you were to or the customer was to cancel the services and say, oh, you know what, never mind, I don't need that work done anymore. Depending on the specifics of the contract, but theoretically, you could have to reimburse the customer this money back. So until you actually own it, even though you have the cash in your account, you don't actually own this cash yet. It still kind of belongs to the customer. You're just in possession of it until you do the thing that would earn you that money, basically. So it's a liability because we have an obligation to provide services to the customer. Okay, this one's a little more straightforward. When you receive the cash when the service is performed, then you just record cash and revenue all at once. There's no ongoing need to collect later. It's going to increase owner's equity, and we have earned the cash because we provided the services, and we also received the cash at the same time. Now here, and this is pretty common, is when cash is received after a service is performed. And this is very common, like I said, as it notes here. Most businesses provide customers with payment terms that allow them to pay after they receive the product or service. So, for example, something very common like utilities, right? We all pay our utility bills after the period in which we've used up the electricity, for example, or the internet, right? Because the business, Comcast or PG&E or whoever it is, they don't know what the bill is going to be, so they can't even there's no way you could really prepay that amount because they won't know what that amount is until the period that they are recording your usage is over. So that's where they send you your, electric bill or whatever, or your internet bill, and you're paying that in the month following when the services were provided. For example, Comcast provides you with internet access and whatever in January. They send you a bill at the beginning of February, and so then you pay it, in February, for example. So a very common situation. There's a term called an invoice, and that's what a business will provide to you as the customer after the services are provided. And the invoice, includes a detail of the services rendered, agreed upon price, etc. Similar to like a bill, essentially. For example, suppose a business provides services, and we send an invoice to the client. At the point at which we're done providing the services, say we are Comcast or we are some business that has provided a service to a customer, and we sent a bill to them, we are owed that money. It is, we've done the thing that they paid us to do, and regardless of when they pay us, we are owed that money now. We have earned it, and so that's why we're going to record service revenue now. But instead of recording the asset of cash, because they didn't pay us yet, so we can't record cash, we're going to use this account called accounts receivable. And that's an asset that is basically like, it represents the fact, whatever's in here is like an IOU from your customer. They owe you money. So this customer now owes you $1,100, and it's going to be paid in cash later. But for now, we're going to put it into this accounts receivable account. We're going to receive this in the future, and we are going to record revenue during that same period because we've earned it already. Okay, let's look at this question here. In January, a company receives a cash deposit from a customer for a service that will be performed and completed in February. Which of the following is true? So when we receive a deposit, remember that's a prepayment, so cash will be going up, but we have not yet earned the revenue because we're going to earn that in February. And we're saying, what do we do when we get the money in January? Well, in January, that's where we're going to record an increase in cash because we did get the money, the customer paid us, but we're also going to record a liability in January for that money, which is called unearned revenue. Okay, recording expenses. Now, as it notes here, expenses, similar to revenues, get recorded when they're incurred. So just like revenues get recorded when they are earned, expenses get recorded when they are incurred, not necessarily when they are paid. So again, say that you're the customer now, you're not Comcast anymore collecting money, but let's say you use Comcast and you're getting your internet bill. Then you incurred that internet bill, say in January, for example, and then you get the bill in February and you pay it, you get the invoice, then you're going to record the expense in January because it was January's internet usage that you are looking at, even though you made that payment in February. And then there's some other instances here that we'll walk through, but 3 different ways, timing instances. You as the customer could pay before the expense is incurred, you could pay when the expense is incurred, and you could pay after. Real similar to the receivable side. Okay, let's talk about paying before the expense is incurred. We discussed this a bit in chapter 1 when we talked about prepaid expenses. And so this is the same concept essentially. And so here we've got an instance for insurance coverage being purchased on January 1 for $3,600. And so and it represents coverage throughout 2018. So it's 12 months of coverage for $3,600. If you divide $3,600 by 12, you get 300 per month, right? Yeah. Okay. Sorry. Do my math in my head. So we can kind of deduce just from this information that the insurance, if we were to spread that out over the 12 months, is $300 per month. And So we're going to record an expense for $300 every month and reduce this prepayment eventually. But on January 1st, 2018, when we make the payment, at the very instant we make it, we have our cash goes down for the payment, and then the prepaid insurance asset, it's another asset, goes up by the full amount. At that point, equity is not affected. It's just one asset being exchanged for another asset. But then at the end of each month, as the contract elapses over time, then we're going to record 1/12 of that expense every month and reduce the value of the asset by 1/12 every month. So here you can see cash goes down, prepaid expenses go up, and that's the very first. That's just when we pay for the policy. And then over time, at the end of the month, of each month, subsequent month, it will go down in this instance by 1/12 because it's a 12-month contract. This is a simple instance. When an expense is incurred, we just record a decrease in cash and we record expense. So cash will go down, expenses will go up. And remember, expenses going up means that owner's equity is decreasing. So pretty straightforward, I think. And then again, a very common occurrence is paying cash after the expenses incurred. And sometimes you'll hear the terminology is you're paying on account. And again, we have to record the expense at the time they're incurred, not when the payment is made, regardless of when the payment is made. So here are the examples saying that if we had some maintenance work done, or we paid for the maintenance work that was done 2 months after the work was completed, then we are going to record that maintenance expense at the time that the service is provided, the specific month usually that it's provided. And then we have an account, we record a liability, we have the expense go up and a liability go up, which and that account that where the liability goes up is called accounts payable, and that will represent the fact that we have to make a payment. Similar to accounts receivable, where we're going to receive cash in the future, accounts payable is a liability that indicates that we're going to have to make a payment of cash in the future. And it decreases equity. Again, it's the same thing as an expense being paid at the same time. It's just saying that expenses go up, equity goes down, and instead of cash being paid, like we saw in the last instance, we have an increase in a liability because we now owe $700 to this supplier, and that's going to be paid at some point in the future. It'll stay on the books here until we make that payment in the future, and we track it here as well, and it lets us as the business owners go in and say, look at all of our amounts that are due to our various vendors and suppliers. Okay, so here we have a question. It says, find a. So this is us, I guess, as a company, or the company at least that we're, from this company's perspective. We contacted a painter in June to paint the office. The office was painted in the following month of July, and then in August we received the invoice and we paid it in September. So when should the expense be recognized? We want to recognize the expense when it was incurred. And it was incurred, we had to pay this after the work was done in July. So July would be the point at which we should record the expense. Okay, let's look at some business transactions here. So this is relatively straightforward, I think, and nothing too complex. This is just kind of saying, what is a business transaction? It's just when a business trades something of value with another person or business causes a change in assets, liability, or equity, but doing business essentially, right? So this could be, as we mentioned before, selling services if you're a service business, selling products, incurring debts between each other, all those kind of things. Sorry for any background noise. That's my son, if you can hear that, screaming in his video games and his friends. Sorry. And really the ultimate goal that we're talking about here is just creating financial statements and being able to assess how the business is performing, essentially, right? So really we're just getting down to that idea of producing financial statements and having a balance sheet, having an income statement, calculating net income or loss, all those kind of things. So very similar to personal accounting from chapter 1, but again, a little more complex, some new accounts, some new names of accounts, and really what this is going to be what the focus of the rest of the chapter or the book, I should say, in the course. And then, going forward, really in your college courses, you'll always have kind of a business focus primarily from your accounting classes. Okay, so let's look at an example business transaction. In this instance, we have an individual, John Smith, depositing $30,000 cash into a new business's bank account. And here it notes when an owner invests his or her own cash into a business, the cash is recorded directly in owner's capital, and it's regarded as owner's equity. And the transaction increases cash and increases capital, or owner's equity, essentially. But the specific account that we use underneath the equity overall heading is capital. So capital goes up, and then cash goes up. And in other words, owner's equity is going up and cash is increasing. And this is the business's cash. If you were to look at the personal financial statements of the owner, then his cash would have decreased and his net worth would have decreased, but it was just moved into the business essentially. Okay, here in transaction 2, if our business borrowed $10,000 from the bank, similar to just taking a loan out, what we discussed in chapter 1, we have cash going up and we have a liability increasing as well. Notes payable here in this instance. And let's notice that this has payable in the name, just like accounts payable. But accounts payable is a different type of liability that usually represents more ongoing purchases, cost of doing business, services provided, whereas notes payable is more associated with loans that the business has taken out. But they're both liabilities. They both have the same increase, decrease, left, right, T account type impact, etc. But again, so cash goes up and liabilities goes up. We have the money, but we also owe the money back at some point in the future as we make payments back on our bank loan. Okay, transaction number 3. If we bought $8,000 of furniture with cash, cash will be going down, furniture will be going up. It's just really that idea of exchanging one asset for another. Furniture is not an expense in this instance because it has ongoing value. You could resell it. It's different than paying for some service or something like that that gets used up quickly. And so we consider furniture to be an asset that will be on the balance sheet and not just be recorded as a $8,000 furniture expense when the purchase is made. Okay, we have an example, transaction 4 here. So if a customer paid $2,000 cash for bookkeeping services to be provided next month, remember the timing here is really important. And so we got money, but we have not yet earned the amounts yet, right? We got the cash, but we're not going to be able to record revenue for that until the following month. Okay. So we use this liability account we discussed previously called unearned revenue, right? And that's going to represent our obligation to provide those services or product in the future. And if we don't provide them, then we have to return the cash. And that kind of fits into this idea of it being a liability, where until we provide those, we technically would need, this is not our money yet, essentially, right? And if we don't provide the business, we have to return the cash to the customer. So again, cash will go up in this instance, but we're not earning the revenue. We're not buying an asset. We just hold the cash and then have a liability until the point at which we provide the services. And maybe we'll see that in a separate transaction. But when the services are actually provided, we're going to see unearned revenue decrease to 0, and then revenue will increase. So it kind of just transfers or transforms from unearned revenue liability to actual revenue on the income statement when the services are provided. All right, in this transaction, we're saying that our business provided services to the customers and just received cash at the same time. So now we would have service revenue and cash. Pretty straightforward. Owner's equity goes up, and that's increases on both sides there. Okay, in this instance, we provided services, but we didn't get paid yet. So we earned the money. So we're going to record revenue because we earned it, but we're still waiting to be paid, right? So in that instance, we're going to record the revenue. It's the plus on the right side, but we're not going to record cash like we did in the previous transaction. Instead, we're going to record the amount to this accounts receivable asset, which again, this just represents amounts that are going to be received, kind of in the name there, I think receivable, going to be received. Okay, in this transaction, we paid $6,000 of cash for a 1-year insurance policy, which started on the first of the month. So again, it's just one asset for another. So even though it's not an asset like furniture was that we saw previously, we can see that it is an asset. We're exchanging cash, one asset for another. And then again, as we talked about previously, this prepaid insurance asset will go down over time as we actually, as time saves an insurance policy for 1 year, at 1/12, every end of every month, 1/12 of this will turn into an expense essentially, and this will be reduced. Okay, we paid cash for all these different expenses for the month, and so here you can see cash going down, and you can see expenses being recorded or going up. In other words, it all decreases owner's equity, and yeah, pretty straightforward. Just like it was for earning revenues, when you're paying cash right at the time that you incur an expense, it really just goes to the expense, and the asset gets decreased. But now let's compare that to receiving a bill or two different bills that are going to be paid later. Then again, we have the same kind of impact as we had with cash being paid, where it's increases to the expenses because we've incurred these expenses, so increase. But what we see in terms of not cash going down, but we see liabilities going up. So we owe this money in the future. It's a payable. We're going to have to pay this in the future. So we got these bills now, and they're going to need to be paid essentially. So liabilities up, expenses up, which expenses up means owner's equity down, and you can see how that all balances. Okay, let's see, transaction 13. We paid $3,000 toward the notes payable. So here we're just going to see cash going down, liabilities going down. This is very similar to what we saw in chapter 1. So sometimes, there's no impact on owner's equity. It's just assets and liabilities changing concurrently. And here we've got a withdrawal. So if the owner withdrew cash for personal use, similar thing, cash goes down. And then we actually reduce owner's equity directly with this account actually withdraws, but it directly goes into a reduction of owner's equity because you're basically just taking money out of the business, kind of a reversal of that contribution, the investment we talked about previously. And that's kind of the whole idea of a business, if you're the owner, is that the business generates revenues and you have cash in the business that can then be withdrawn for personal use, right? It's how you're getting paid by the business essentially. Okay, let's see. A customer paid $500 for the amount owed for bookkeeping services. So now we received some cash. We had done the services last month, for example, and we recorded revenue and accounts receivable, remember. But now we have actually received the payment. And so cash is going to go up at this point. And now accounts receivable, which was on our books from last month, indicating that we were due money, is now going to be reduced, and because we've actually received the cash. So it's kind of like an IOU, or a placeholder until the cash is received. Cash has been received, so we reduce the receivable. It will no longer be received because it's already been received. And we're kind of exchanging one asset for another again, like we talked about previously. Here's a kind of different instance where we're paying an accounts payable. So again, let's say the previous month we recorded accounts payable, we increased it, and we increased expense. But now in the following month, we're going to pay that bill now. And so here in the following month, we just have a decrease in cash and a decrease in that payable because it's now been paid. Let's see here. So this one says, what transaction would result in an increase in cash and an increase in owner's equity? So here we would have an increase in cash. there's a few different ways that could happen. The owner depositing money into the bank, I think, the business here is the answer that this one will tie into. And yep. So that's a contribution, remember. Okay, now let's talk a little bit, so that we talked about transactions there, and then here we're going to talk about financial statements. And there's a few just formatting standards that you'll see, and you'll see these when we do work problems and things. Each statement has some lines at the top. You've got the name of the company, what statement it is, and the time period that it covers. Yeah, I'm not going to, they can, that's important, the headers, and then you've got some standard structure on how you'll see, revenues and expenses and things. And you can see here an example of that. We've got revenues of $19,000, different expenses that all total to $9,600. Revenues minus expenses. We have more revenue than expense, so we have a net income, and we get $9,400. And so that's the first type of income statement, financial statement that we call the income statement. Remember that income statement is the income, revenues, and expenses over the accounting period that we're looking at, typically a given month, and it's over that whole month. We've earned and paid, incurred. We've earned these revenues and incurred these amount of expenses. And then our second statement that we're going to look at here, second financial statement, is called the statement of owner's equity. And it just shows us how that owner's equity account has changed during the month. And so we have that capital account for Smith, who's the owner, under the overall heading of owner's equity. And since this was a new business that just started during the month, the capital account, the equity account was zero to begin. He contributed $30,000 into the business as an investment, and then the business earned $9,400 in net income. And then he withdrew $2,000. So it went up by $30,000, it went up by $9,400 because we had net income, and then it went down by $2,000, not from expenses, but from just the owner just taking the money out of the business for personal use. Okay, here the last financial statement that we will look at is called the balance sheet. And the balance sheet, remember, is going to be on a specific date, not over the time period of a specific period like it is for the income statement or the statement of owner's equity. But the balance sheet is just as of the end of that month. And again, remember, it's got assets, liabilities, and then owner's equity listed out. And you can see the owner's equity is what we calculated from the owner's equity statement, and that will be under the equity section there. And again, assets equal liabilities plus equity, and it all has to balance there. Okay, let's talk about the sequence of assets and liabilities. We talked about this a little bit previously. This is where I was mentioning that assets are listed in sequence according to their liquidity. So the most liquid, cash is the most liquid asset, followed by accounts receivable, and then again, property, plant, and equipment, such as buildings and machinery, are the hardest to convert to cash or least liquid, and therefore they will be listed last. And then liabilities are listed in sequence of those that are going to be paid first. Typically, accounts payable will be first, and then notes payable that are going to be more long-term debts are listed farther down or last. So again, here you can kind of see. Start with cash, go down to property, plant, and equipment. Start with accounts payable, goes down to notes payable or things of that nature. There's another statement called the statement of cash flows. We're not going to spend much time here on this, the statement of cash flows, so I'm just going to kind of skip over that for now. And here this question asks, which of the following information is not included in the three lines at the top of the company's financial statement? So remember, we have the company's name, the statement name, income statement, balance sheet, etc., and then the time period or date that the statement covers. But nowhere in there do we need to list out what the industries, the company's sector, or anything like that. It's just those three lines of the name, what is the account, or what is the financial statement, and then what is the time period. Ethics here, kind of shifting gears a little bit into not talking about the technical aspects of accounting and all that here necessarily, but a really important concept to keep in mind here is this concept of ethics. And you might have heard about ethics before, maybe not in a business context per se, but ethics in both a personal and a business context, basically, as it's mentioned here or described here, are a set of guidelines that define if a behavior is moral or not. And it's not always exactly clear cut whether something is ethical. And then you can run into these things called ethical dilemmas, where the decision, as it says, may positively affect one group but negatively affect another. And so really it just requires the individual, or whoever's looking at this situation, to evaluate all the outcomes and make a decision, hopefully an optimal decision. And here specifically when we talk about ethics in accounting, as it mentions here, the owners and managers have some level of control over how the revenue and expenses are recorded and reported. And those owners and managers have an ethical responsibility to make sure that the accounting that they're doing and the reporting is done in a way that best represents economic reality, even if doing that sometimes means that there could be some unfavorable outcomes. So, and this has occurred in the past. You might have heard of some accounting fraud type situations, or business fraud, white collar fraud they call it sometimes, where a business might be lying about something in order to, get some type of favorable result. And so we as accountants, really have a duty to report the information, not what we want it to be, but as it is. Because reporting it as the owners want it to be might not reflect reality, and that could be moving into the realm of fraudulent activity, essentially. So we as accountants really have a duty to act ethically and be transparent and just reflect reality, and not be hyperbolic or trying to represent things that are untrue, even if and then it can be very often that maybe pressure, this is a concept called the fraud triangle. There's pressures that can be applied to you, maybe in an accounting position, to try and report things inaccurately in order to help the business or help the owners, etc. And so specifically with this concept of the fraud triangle, there's often three factors present when frauds happen. And so you've got, the pressure, rationalization, and the opportunity. And when you find situations where there is pressure, the individual who can commit fraud has some sort of rationalization. Somehow they rationalize their behavior in a way that, what they're doing isn't so bad, or it has to be done. Maybe, and then the individual has the opportunity to actually do the fraudulent thing, whatever its action is. And so you can think of some pretty significant, challenging ethical dilemmas that could arise. Say, for example, someone working at a company who's maybe the bookkeeper for a company or something. Maybe they have pressure because they have some sort of medical issue or something, and they don't have the money to pay for it or something along those lines. And so they can have that pressure. They don't have the money to pay for what needs to be done. They could rationalize the fraudulent act. Maybe they're stealing from the business, but they're rationalizing it by saying, if I don't get this money, there's some negative health outcome that could occur. And then if they have the opportunity to actually steal that money, and often maybe it's not such a, a lot of times when you hear about frauds, it's more about just things like gambling debts or poor lifestyle type stuff. I don't know that I've really heard about someone with a specific health issue, but I just want to make the point that those are the kinds of things that occur that can lead to fraud. Maybe the individual has a gambling problem. They have debts that they need to repay that they don't have the money to repay. They rationalize stealing money from their company by saying that the company treats them poorly or something. And then if they have the opportunity to actually steal that, when you see these three things occurring simultaneously, that's when you have a higher risk for fraud to occur. And they call that the fraud triangle, because there's three different factors, like a triangle, 3 sides. So which of the following is unethical here? Borrowing cash from a bank that charges a high interest rate. That's not unethical. That's just a decision that you make, pro and a con. Maybe a high interest rate is something that you are okay taking on because you need the cash really badly, or maybe you're going to pay the loan back quickly. So high interest rate doesn't really make that much of a difference. But you have a choice here, and this is just a choice that can be made from a business perspective. Recording customer deposits as revenue before services are performed to inflate net income. Yeah, I think that one sounds pretty unethical, right? Remember, when we record a customer deposit, it's supposed to be recorded as a liability called unearned revenue because we have not yet earned that money. And so technically it is the customer's money. It's not net income yet because it's a liability, not revenue. But we could, as the accountant, make not record it correctly and record it as revenue in order to make the business look better. And so that would be an unethical act. So that one I think is the answer here. Some of the other and possible answers. So if we're recording expenses when they are incurred to minimize taxes, no, that's what you're supposed to do. When you incur expenses, you do record them. I mean, that's the whole thing that we're talking about. And recording expenses does reduce income taxes because it's based on your net income. So that's just a result of having business expenses. It's not anything unethical. It's just how income taxes work. And then D says the owner withdraws cash for personal use and records it in the owner's withdrawals account. And that's, again, the same exact. That's what you're supposed to do. The owner's taking money out of the business that the business has, and the owner is allowed to do that. And that's how you accurately record it in the accounting records. So yeah, definitely recording deposits before they're earned, be unethical. Okay, so let's just go through the summary here, and then we'll wrap up this lecture. So listing the differences between personal accounts and business accounts. Some of the differences include the ideas, the concepts of surplus and deficit are just now called net income or net loss. Revenue can be classified as sales revenue or service revenue, depending on whether you're a service business or a merchandiser or manufacturer who's selling products. Net worth section is replaced with the owner's equity section. Describe the sequence of assets and liabilities. So again, remember, we record the assets in order of liquidity, cash first, and then liabilities are listed in order with those that are going to be payable within the shortest amount of time, ending with long-term debts. 3 main types of businesses. We have the service business, which just provides services to clients, doesn't sell any products, no goods at all sold. A merchandising business buys finished goods and resells it to customers, a middleman. Think of Walmart, or think of any gas station, or think of any company that just sells other products that are made by other companies. And then we have a manufacturing business, which is the one that actually makes those products that merchandisers sell. And sometimes the manufacturing business might sell to the customer directly, but often the manufacturers just focus on producing the products, and then they just sell them wholesale to merchandisers or retailers, and they let the retailers handle the interaction directly with the customer. Okay, so we talked about the fact that we need to record revenue based on this concept of accruals, and what that means is recording the revenue when it's earned, not when the cash is received. And remember that we use this new account called accounts receivable to represent that notion that we increase revenue and we increase accounts receivable in place of cash until the cash is received later, right? It's kind of a placeholder for cash that will be received. And then similarly on the expense side, we record expenses when they're incurred, regardless of when the cash is paid. We have prepaid expenses, when we pay for something like an insurance contract at the beginning of the year. So we have these 2 different accounts. We can use prepaid expenses, but then we also use accounts payable when we record expenses incurred that haven't been paid yet. So again, similar to accounts receivable, but accounts receivable being an asset that represents amounts of cash that will be received accounts payable is a liability that represents cash that will be paid in the future. And then we talked about the financial statements. We have the statement of owner's equity, and that's a new financial statement that we didn't look at in personal accounting. And then we talked about business ethics and the notion that businesses should report the financial statements in a way that reflects the true substance of the transactions and not misrepresent financial information just because it's favorable to someone or there's pressure to do that, etc. Acting ethically from a business perspective is extremely important because accountants are often in a position to potentially misrepresent financial information. And it's kind of our duty as good citizens in the business world to ensure that things remain above board and are transparent and accurate. All right, well, that brings us to the end of chapter 2. We'll work on some exercises in class, and the homework and the workbook exercises as well will all help us to make sure that we understand these concepts and how to apply them. All right, well, thanks, everybody. I will see you in class, and hope you all are having a good day or evening or whatever time it is for you. All right, we'll see you soon.